very quickly, let's run through the 4 factors that go into a mortgage payment. If you understand the acronym of PITI, that simply stands for principal, interest, taxes, and insurance. If you're a real estate investor, you know these 4 letters like the back of your hand. If you don't, let's run through these very quickly. So P stands for principal. This is simply just the amount of money that you owe the bank for lending you to be able to purchase the house that you're moving into, okay? So the example that we're going to be using for this video is a $350,000 house, and we're going to be putting 20% down. So in the comment section below, tell me what the down payment amount is if we're putting down 20% on $350, and what is the mortgage amount going to be. You can pause the video here. Okay, so if you answered $70,000 for the down payment and you owe $280 on the mortgage, that is the correct answer. So moving on, what is interest? Interest is simply just the rate at which you are borrowing the money from the bank. You're paying the bank to borrow their money. That is how the bank is compensated, okay? So the higher risk you are, meaning the lower credit score you are, the higher the rate that the bank needs to make in order to compensate themselves for taking on risk. AKA, you're going to get a higher interest rate on your mortgage. So higher risk, higher rate. Lower risk, lower rate. The better your credit, the lower this interest is going to be. So I'll show you how affecting the interest numbers actually affects you in the long term in my spreadsheet later in this video. T is taxes. This is a no-brainer. So property taxes are used to help fund schools, infrastructure, government workers, things like that. That is why property taxes are a part of owning a home. And then finally, we have insurance. So insurance sounds just like what it is. Property insurance is if a tree falls on your house, it's just like car insurance. You're going to get compensated after some sort of deductible. However, there's this other thing down here called PMI, which is private mortgage insurance. So typically, if you put less than 20% down on a property, PMI, private mortgage insurance, is typically there to allow the lender to get some breathing room, if you will. This doesn't go towards the principal of your payment. It just allows the bank to be able to turn your property into a security and sell that mortgage to other bigger banks. And it also gives them a little bit less risk for taking on that mortgage if you don't have 20% down.